All right, let's talk about that feeling. Your paycheck hits, you pull up your banking app, you see that gorgeous number sitting there, and for maybe 3 seconds, you feel like a millionaire. And then, poof, life happens, and by next week, you're left wondering, wait, where did it all go?
Yeah, this whole payday Friday versus broke Wednesday thing, it's a cycle so many of us are trapped in. You get that amazing high when the money lands, but it's followed by that sinking feeling in the pit of your stomach when you realize there is way, way too much month left at the end of your money.
I mean, it is a total emotional roller coaster, right? On Friday, you've got this sense of abundance. You're making plans, your account looks healthy, life is good. But by Wednesday, that feeling is just gone. It's replaced with anxiety, maybe a little bit of panic, and you're just scraping by. It is a brutal, brutal cycle. But here's the twist. For most of us, the real problem isn't the size of the paycheck. It's not about income. It's about the process. The truth is, we've been taught to handle our money in the completely wrong order, a backwards approach that practically guarantees we stay stuck right where we are. So, what's the fix? Well, we're going to borrow a really simple but incredibly powerful idea from the world of productivity. It's a concept called eating the frog. Sounds weird, I know, but stick with me. The whole idea is actually brutally simple. Your frog is that one big, important, kind of intimidating task that you are most likely to put off. So, the rule is you do that thing first thing in the morning. Get it out of the way. When you do that, the rest of your day feels easier, and you've already locked in a major win. And that brings us to your money. What's the biggest, ugliest, most important financial task you've been avoiding? It's not paying the rent. It's not buying groceries. The frog is paying your future self. It's funding your savings and your investments before you do anything else. And this slide right here, this shows you the fundamental difference. Most of us live on the left side of this chart. We get paid, we spend some money, we pay our bills, and then we tell ourselves we'll save whatever's left over, which, let's be honest, is usually zero. The wealthy completely flip the script. First, they save and invest. Then they pay their bills, and only then do they spend what's left. It's a total game changer. So this new way of thinking gives us a clear, new order of operations for every single payday. It's a 5-step process that's designed to make sure you're actually building wealth, not just treading water. Okay, here's the new playbook. Step 1, and this is the big one. It's non-negotiable. You eat the frog. You pay yourself first, immediately. Step 2, you make sure you're current on all your debt minimums. This protects your credit score. From there, step 3, you build up a cash buffer, your emergency fund. Once that's solid, you move to step 4, you start systematically investing for your future. And finally, when all of that is on autopilot, you can go on the attack and start aggressively paying down that high-interest debt. Now, let's really dig into step 1, because this is the engine that makes the whole system work. It isn't just about saving money, it's about creating a powerful psychological shift in how you see every dollar you earn. Let's make this real with a quick example. Say you take home $4,000 a month. The old way, you might have $3,800 to cover everything, and maybe you'd scrape together a couple hundred for savings. But in the new way, the very first thing you do is transfer $800 to savings and investments. Boom, done. Now you only have $3,200 left. This creates a constraint. It forces you to get creative, to be ruthless, to live on less, and that is exactly the point. Okay, so you've paid yourself first and you've covered your minimums. Now we have to talk about building a buffer. Let's look at step 3, the emergency fund. This is so much more than just a pile of cash. This is the machine that breaks the cycle of debt. Think about it. When you don't have one, a flat tire becomes a credit card crisis. But with an emergency fund, that same exact event is just an inconvenience that you write a check for. It turns crises into inconveniences. And the target here is really clear. You want to have 3 to 6 months of your essential living expenses saved up. We're talking needs, not wants. And this money has to sit somewhere boring and safe, like a high-yield savings account where you can get it immediately. It cannot be tied up in the stock market. Now, once that emergency fund is looking healthy, it is time for step 4, investing for the future. And this is where I hear the biggest objection of all. People say, oh, I'll start when I'm older, or I just don't make enough right now. But I'm telling you, the math shows that this is one of the most expensive thoughts you can possibly have. Just look at these numbers. They don't lie. If you invest just $100 a month starting at age 25, you could end up with over $250,000 by retirement. But if you wait just 10 years to start that exact same habit, you end up with half as much. Half! You literally cut your retirement savings in half just by waiting. Time is your most powerful asset. And hey, if your job offers a 401k match and you are not taking it, you are voluntarily giving up a raise. You're leaving free money on the table. Over a 30-year career, that free money you ignored could compound to nearly $300,000. It is financial self-sabotage, pure and simple. So finally, once your savings and investments are humming along on autopilot, it's time for step 5. You get to attack that high-interest debt. And you've got two great options. There's the debt snowball, which is all about psychology. You pay off your smallest debts first to get those quick wins and build momentum. Then there's the debt avalanche, which is the pure math approach. You target the debt with the highest interest rate first, which saves you the most money. Honestly, the best method is whichever one you will actually stick with. Consistency wins. Now, I know what some of you might be thinking. This all sounds restrictive. It sounds like you can't have any fun with your money, but that is completely backwards. This system is actually about creating true financial freedom. This quote nails the mindset perfectly. Being wealthy isn't about not spending money. It's about spending money intentionally. Once you've eaten the frog, once you've paid yourself first and handled your responsibilities, the money that's left over for fun, you can spend that completely, 100% guilt-free. It's not stealing from your future. It's just enjoying the benefits of your awesome plan. So this all comes down to one thing really, your very next payday. You're going to have a choice to make. What's it going to be? Are you going to keep doing what you've always done and keep getting the same stressful paycheck-to-paycheck results? Or are you finally ready to try something different? Are you ready to eat the frog? Because that's the honest truth of it. Making that first transfer to savings before you do anything else, yeah, it might feel a little uncomfortable at first. It might taste terrible going down, but the feeling of control, the security, and the excitement of building a future you actually want, trust me, that tastes pretty sweet.